I am James Moria. I'm the Group Chief Executive Officer of Centum Investment. Yeah, so Centum, we've come a long way. Last year was the last year of our Centum 3.0 strategy. That was a strategy we were running for the last 5 years, and that saw us grow more or less double our net asset value per share. We developed our private equity portfolio. We began our real estate portfolio, which did relatively well, worked on the development and marketable securities. We launched Centum 4.0 in March of this year. So we are now 6 months into the new strategy. And the focus of the new strategy, in keeping with the opportunities we see in this environment, is one, to strengthen the balance sheet by deleveraging. We are taking on quite a bit of debt to fund our foray into new areas, and we made a decision to be completely debt-free. We were targeting to be so in 2 years, but it looks like we may achieve that objective by June of next year, and to also build up our cash position significantly. And we've made significant progress in doing that. So that was really the main pillar of the strategy. And then to use that enhanced cash position to take advantage of the opportunities that we see coming up in the market. Because in our view, we are probably where we were in 2008, 2009. And we see quite good opportunities for those who are going to be holding cash in the market as we get into a new economic cycle. On our real estate business, it has been a busy period. We currently have 1,300 units under construction across the entire portfolio. And our development model is customer-led. So we follow the customer and we build to fulfill the needs of the customer. So to that end, we've sold about more than 60% of everything we're building is already sold, and I'll be speaking more about it at the investor briefing. On our marketable securities portfolio, which is run by NABO, we've had a shift from focusing on capital gains to focusing on recurrent income. So they have shifted the portfolio significantly from equities to fixed income securities across the continent. Because as you know, our markets have not done well in the last couple of years. But our objective as Centum and to our investors is to deliver returns regardless of the economic conditions, and to always take advantage of whatever conditions are there to deliver the best possible return. So they continue to do a good job in that regard. So that's where we've come from, and this is the environment we're going into, and it's therefore very, very exciting for all of us. You know, we invest across the continent. So we are not just a Kenyan investor. And so we are optimistic about the opportunities we see coming up, arising out of the conditions that are there. And so we see this as a buyer's market, because it's always important to time your investments so that you know when to buy and when to sell. So we've just come out of a phase where we've had a number of exits, and I think we're coming to the tail end of that phase. We are now going to the next phase where we'll be buyers, and it helps to be a buyer when liquidity is tight, which I think is the environment we are getting into. So I think we'll have a good choice of assets to choose from, and then to start building them up again, and possibly in another 10 years again to be back where we are today, where we'll be exiting hopefully at a profit. We just concluded our largest exit ever actually on the last day of September 2019, which was a sale of our stake in the bottlers, and that was net of taxes. Gross of taxes was 19.4 billion shillings. That single exit was more than all the other exits we've done over the last 4 years combined, and it was done in this economic environment. So again, as I say, is our motto, our promise is to deliver regardless of the conditions. My driving force is to make a difference, is to be a change of transformation, is to be for Centum to be counted as one of those organizations that developed this region. And if you look at what we've done across our various businesses, whether it's in real estate, having come into this line 10 years ago, the projects we've done, whether it's in Two Rivers, in Vipingo, in Palmarina in Uganda, they've been defining. We've changed the landscape of that environment. If I look at the companies that we've been involved in our private equity business, again, it's been transformative. If I take Almasi, when we came in, total profits were 100 million. By the time we left, it was more than 1 billion shillings, 10 times growth. For me, that's my motto, is that whatever I'm involved in, I want it to be world-class. And I want us to really transform not just the organizations we're involved in, but the industries, and to touch the lives of people positively. As a shareholder, I'm also a shareholder of the business. I think the share price today represents significant value for investors. We're trading at about 30 shillings a share. The cash component of our business on a per share basis is almost 10 shillings. That's just cash and cash equivalents. When I add our private equity business in there, we're already above 30 shillings. So the real estate and the development side of our business, which is doing very well, for you buying the share today, you're essentially getting it for free. It is not included in the valuation. So whether it's Two Rivers, whether it's Vipingo, it's Palmarina, it's not factored in the valuation. And as I said, to date, we've sold over 60% of everything we are building. And even the valuation we are carrying it at is very conservatively valued. So this price represents a very significant entry opportunity for incoming investors. For existing investors, it represents an opportunity for you to buy more shares of the company and not to sell, and to enjoy the gain that I believe will come when we eventually unlock the gap and the valuation mismatch in our share price. This Thursday at the investor briefing, we'll take time to expound on where we are on our strategy implementation process, where we are across the 3 verticals, where we are on each of the strategic objectives that we set out. We'll also be announcing our 6 months results. But more importantly, you'll get a sense of where the business is going and the progress that we are making. So we're all very excited to be meeting with our investors 6 months into the strategy implementation process to explain to them where we are and where we are going. So I would like to invite you on Thursday morning at the NSE, or to join us on live streaming, to follow us to follow the investor briefing and to participate and to pose questions to us. I am James Moria. I'm the Group Chief Executive Officer of Centum Investment. Yeah, so Centum, we've come a long way. Last year was the last year of our Centum 3.0 strategy. That was a strategy we were running for the last 5 years, and that saw us grow more or less double our net asset value per share. We developed our private equity portfolio. We began our real estate portfolio, which did relatively well, worked on the development and marketable securities. We launched Centum 4.0 in March of this year. So we are now 6 months into the new strategy. And the focus of the new strategy, in keeping with the opportunities we see in this environment, is one, to strengthen the balance sheet. am James Moria. I'm the Group Chief Executive Officer of Centum Investment. Yeah, so Centum, we've come a long way. Last year was the last year of our Centum 3.0 strategy. That was a strategy we were running for the last 5 years, and that saw us grow more or less double our net asset value per share. We developed our private equity portfolio. We began our real estate portfolio, which did relatively well, worked on the development and marketable securities. We launched Centum 4.0 in March of this year. So we are now 6 months into the new strategy. And the focus of the new strategy, in keeping with the opportunities we see in this environment, is one, to strengthen the balance sheet by deleveraging. We are taking on quite a bit of debt to fund our foray into new areas, and we made a decision to be completely debt-free. We were targeting to be so in 2 years, but it looks like we may achieve that objective by June of next year, and to also build up our cash position significantly. And we've made significant progress in doing that. So that was really the main pillar of the strategy. And then to use that enhanced cash position to take advantage of the opportunities that we see coming up in the market. Because in our view, we are probably where we were in 2008, 2009. And we see quite good opportunities for those who are going to be holding cash in the market as we get into a new economic cycle. On our real estate business, it has been a busy period. We currently have 1,300 units under construction across the entire portfolio. And our development model is customer-led. So we follow the customer and we build to fulfill the needs of the customer. So to that end, we've sold about more than 60% of everything we're building is already sold, and I'll be speaking more about it at the investor briefing. On our marketable securities portfolio, which is run by NABO, we've had a shift from focusing on capital gains to focusing on recurrent income. So they have shifted the portfolio significantly from equities to fixed income securities across the continent. Because as you know, our markets have not done well in the last couple of years. But our objective as Centum and to our investors is to deliver returns regardless of the economic conditions, and to always take advantage of whatever conditions are there to deliver the best possible return. So they continue to do a good job in that regard. So that's where we've come from, and this is the environment we're going into, and it's therefore very, very exciting for all of us. You know, we invest across the continent. So we are not just a Kenyan investor. And so we are optimistic about the opportunities we see coming up, arising out of the conditions that are there. And so we see this as a buyer's market, because it's always important to time your investments so that you know when to buy and when to sell. So we've just come out of a phase where we've had a number of exits, and I think we're coming to the tail end of that phase. We are now going to the next phase where we'll be buyers, and it helps to be a buyer when liquidity is tight, which I think is the environment we are getting into. So I think we'll have a good choice of assets to choose from, and then to start building them up again, and possibly in another 10 years again to be back where we are today, where we'll be exiting hopefully at a profit. We just concluded our largest exit ever in actually on the last day of September 2019, which was a sale of our stake in the bottlers, and that was net of taxes. Gross of taxes was 19.4 billion shillings. That single exit was more than all the other exits we've done over the last 4 years combined. And it was done in this economic environment. So again, as I say, is our motto, our promise is to deliver regardless of the conditions. My driving force is to make a difference, is to be a change of transformation, is to be for Centum to be counted as one of those organizations that developed this region. And if you look at what we've done across our various businesses, whether it's in real estate, having come into this line 10 years ago, the projects we've done, whether it's in Two Rivers, in Vipingo, in Palmarina, in Uganda, they've been defining. We've changed the landscape of that environment. If I look at the companies that we've been involved in our private equity business, again, it's been transformative. If I take Almasi, when we came in, total profits were 100 million. By the time we left, it was more than 1 billion shillings, 10 times growth. For me, that's my motto, is that whatever I'm involved in, I want it to be world-class. And I want us to really transform not just the organizations we're involved in, but the industries, and to touch the lives of people positively. As a shareholder, I'm also a shareholder of the business. I think the share price today represents significant value for investors. We're trading at about 30 shillings a share. The cash component of our business on a per share basis is almost 10 shillings. That's just cash and cash equivalents. When I add our private equity business in there, we're already above 30 shillings. So the real estate and the development side of our business, which is doing very well, for you buying the share today, you're essentially getting it for free. It is not included in the valuation. So whether it's Two Rivers, whether it's Vipingo, it's Palmarina, it's not factored in the valuation. And as I said, to date, we've sold over 60% of everything we are building. And even the valuation we are carrying it at is very conservatively valued. So this price represents a very significant entry opportunity for incoming investors. For existing investors, it represents an opportunity for you to buy more shares of the company and not to sell, and to enjoy the gain that I believe will come when we eventually unlock the gap and the valuation mismatch in our share price. This Thursday at the investor briefing, we'll take time to expound on where we are on our strategy implementation process, where we are across the 3 verticals, where we are on each of the strategic objectives that we set out. We'll also be announcing our 6 months results. But more importantly, you'll get a sense of where the business is going and the progress that we are making. So we're all very excited to be meeting with our investors 6 months into the strategy implementation process to explain to them where we are and where we are going. So I would like to invite you on Thursday morning at the NSE, or to join us on live streaming, to follow us to follow the investor briefing and to participate and to pose questions to us. I'm James Moria. I'm the Group Chief Executive Officer of Centum Investment. Yeah, so Centum, we've come a long way. Last year was the last year of our Centum 3.0 strategy. That was a strategy we were running for the last 5 years, and that saw us grow more or less double our net asset value per share. We developed our private equity portfolio. We began our real estate portfolio, which did relatively well, worked on the development and marketable securities. We launched Centum 4.0 in March of this year. So we are now 6 months into the new strategy. And the focus of the new strategy, in keeping with the opportunities we see in this environment, is one, to strengthen the balance sheet by deleveraging. We are taking on quite a bit of debt to fund our foray into new areas, and we made a decision to be completely debt-free. We were targeting to be so in 2 years, but it looks like we may achieve that objective by June of next year, and to also build up our cash position significantly. And we've made significant progress in doing that. So that was really the main pillar of the strategy. And then to use that enhanced cash position to take advantage of the opportunities that we see coming up in the market. Because in our view, we are probably where we were in 2008, 2009. And we see quite good opportunities for those who are going to be holding cash in the market as we get into a new economic cycle. On our real estate business, it has been a busy period. We currently have 1,300 units under construction across the entire portfolio. And our development model is customer-led. So we follow the customer and we build to fulfill the needs of the customer. So to that end, we've sold about more than 60% of everything we're building is already sold, and I'll be speaking more about it at the investor briefing. On our marketable securities portfolio, which is run by NABO, we've had a shift from focusing on capital gains to focusing on recurrent income. So they have shifted the portfolio significantly from equities to fixed income securities across the continent. Because as you know, our markets have not done well in the last couple of years. But our objective as Centum and to our investors is to deliver returns regardless of the economic conditions, and to always take advantage of whatever conditions are there to deliver the best possible return. So they continue to do a good job in that regard. So that's where we've come from, and this is the environment we're going into, and it's therefore very, very exciting for all of us. You know, we invest across the continent. So we are not just a Kenyan investor. And so we are optimistic about the opportunities we see coming up, arising out of the conditions that are there. And so we see this as a buyer's market, because it's always important to time your investments so that you know when to buy and when to sell. So we've just come out of a phase where we've had a number of exits, and I think we're coming to the tail end of that phase. We are now going to the next phase where we'll be buyers, and it helps to be a buyer when liquidity is tight, which I think is the environment we are getting into. So I think we'll have a good choice of assets to choose from, and then to start building them up again, and possibly in another 10 years again to be back where we are today, where we'll be exiting hopefully at a profit. We just concluded our largest exit ever actually on the last day of September 2019, which was a sale of our stake in the bottlers, and that was net of taxes. Gross of taxes was 19.4 billion shillings. That single exit was more than all the other exits we've done over the last 4 years combined, and it was done in this economic environment. So again, as I say, is our motto, our promise is to deliver regardless of the conditions. My driving force is to make a difference, is to be a change of transformation, is to be for Centum to be counted as one of those organizations that developed this region. And if you look at what we've done across our various businesses, whether it's in real estate, having come into this line 10 years ago, the projects we've done, whether it's in Two Rivers, in Vipingo, in Palmarina, in Uganda, they've been defining. We've changed the landscape of that environment. If I look at the companies that we've been involved in our private equity business, again, it's been transformative. If I take Almasi, when we came in, total profits were 100 million. By the time we left, it was more than a billion shillings, 10 times growth. For me, that's my motto, is that whatever I'm involved in, I want it to, as a shareholder, I'm also a shareholder of the business. I think the share price today represents significant value for investors. We're trading at about 30 shillings a share. The cash component of our business on a per share basis is almost 10 shillings. That's just cash and cash equivalents. When I add our private equity business in there, we're already above 30 shillings. So the real estate and the development side of our business, which is doing very well, for you buying as the share today, you're essentially getting it for free. It is not included in the valuation. So whether it's Two Rivers, whether it's Vipingo, it's Palmarina, it's not factored in the valuation. And as I said, to date, we've sold over 60% of everything we are building. And even the valuation we are carrying it at is very conservatively valued. So this price represents a very significant entry opportunity for incoming investors. For existing investors, it represents an opportunity for you to buy more shares of the company and not to sell, and to enjoy the gain that I believe will come when we eventually unlock the gap and the valuation mismatch in our share price. This Thursday at the investor briefing, we'll take time to expound on where we are on our strategy implementation process, where we are across the three verticals, where we are on each of the strategic objectives that we set out. We'll also be announcing our 6 months results. But more importantly, you'll get a sense of where the business is going and the progress that we are making. So we're all very excited to be meeting with our investors 6 months into the strategy implementation process to explain to them where we are and where we are going. So I would like to invite you on Thursday morning at the NSE, or to join us on live streaming, to follow us to follow the investor briefing and to participate and to pose questions to us.
To be here. Good morning. Thank you very much for joining us on this lovely Thursday. Thank you for taking the time to be with us as we do our half-year 2020 investor briefing and results release. To the online community, thank you for your patience, for bearing with us. We are kicking off shortly, but before we begin, I'd like to invite Pius Mashiri just to give us a word of prayer.
Good morning, everybody. You all look happy, you all look sharp, smart. Yeah? Let's close our eyes. Our Heavenly Father, we want to come before you with thanksgiving in our hearts. We are grateful that that you've gathered us here, our investors, the team that has been leading Centum. We're grateful for this, Father, that you have brought us. We want to commit this meeting unto you. We want to ask you to make these deliberations fruitful. May you guide this company. We want to commit all our future plans unto your hands. It is in Jesus' name we do pray and believe. Amen.
Thank you very much, Pius, for those words. Pius is also the managing director of Nabo Capital, which is a wholly owned subsidiary that manages our marketable securities portfolio, and our group CEO will speak to that and how it's been performing to date. To those who are following the conversation online, feel free to share your comments, feedback, questions through the hashtag Centum HY2020. We are more than happy to engage with you during the forum, and there'll also be live tweets. The presentation is online and you can find it on our website just to follow the conversation. Without further ado, I'd like to invite our group CEO and managing director, Dr. James Moria. Okay.
Morning, everyone. My name is Terry Adambesa. I take care of the derivatives market at the exchange, and I'm hosting you today on behalf of the chief, who is on duties out of the country. Welcome, Centum. We hope that this is the first of many of investor briefings to be held at the exchange. We haven't had any, so this is going to be a welcome move. So karibu everyone to the exchange. I hope you've enjoyed the hospitality, and we'll hope to see more of you. Karibu.
Thank you, Terry, for welcoming us. Good morning, ladies and gentlemen. No, it's a big pleasure to be here this morning to share with you our results announcements, particularly because we are doing it at the NSE. I sat on the board of NSE for several years, and it was always our aspiration that issuers would have the events here at the NSE, so it's wonderful to be here. I would like to also welcome those who are following us online. I know there are a number of us who are following us online, and just to confirm with George that you've posted the presentation online so that they can follow. I know you may have questions, so George, you want to repeat where they can post their questions?
Yes, to those following the conversation online, you can post your questions by tagging @Centum PLC or through the hashtag Centum HY2020.
Thank you very much. Thank you very much, George. So I see a number of my colleagues in the room. I think as I discuss the performance of their businesses, I'll introduce them at that time. But I'd just like to introduce Michael Mugasa, who is here. Michael is our audit partner from PwC. And I'll be doing this presentation with our CFO, Sam, who is also right here. So you'll get to hear from him. So we've completed the half year 2019-2020. It's the first 6 months of our new strategy period, which is Centum 4.0. At the last investor briefing, we shared with you what our strategic objectives were and the reasons they were as so. So our big objectives were going into the economic environment we're going into, where we see opportunities. One was to deleverage the balance sheet. The second one was to significantly enhance our cash position. And the third was also to increase the uptake of our real estate portfolio in the market so that we could release cash. In the last 6 months, we've made progress. From a holdco debt perspective, we've paid all the debt, save for the bond that is maturing in May next year, 6.4 billion, and that we expect to retire fully. So we should achieve this objective by May of 2020, when this bond comes up to mature. We enhanced the cash position. I think we closed at roughly 500 million. We've now closed at about 13.6 billion. So it's roughly 9 billion in cash and 4 billion in undrawn facilities. So we have access to about 13 billion of liquidity at the Centum holdco. from an uptake perspective, which I'll be speaking about, we are currently developing 1,316 units across our various 3 projects, Two Rivers, Palmarina, and Vipingo. Of that, we've sold about 62%, about 800 units. And when we mean by selling, we've received about 22% of the sales proceeds. And those projects are progressing well. They have no debt on their balance sheet, and I'll also speak about where we are on land monetization. Performance again is a strategic pillar. From a return perspective, we are on track. From a capital structure and liquidity perspective, as I've explained, we're also on track. Operating costs, we set ourselves a target to operate at 30% of cash annuity income. We are on track. I believe we should be there by full year next year. We should be within the 30% range. And really the objective is to ensure that we can cover both our dividends and our cash annuity and our operating costs from the cash annuity income, so that any disposals that we do are then used to, that cash is then redeployed into other assets, and any debt that we take into the future is then directly redeployed into other assets. I'll discuss where we are from an asset allocation perspective. I hope those who are following online are following the presentation. If you have an issue, just post it and we'll deal with it. The team will deal with it. So this is our segmental performance. Real estate, as I've explained, 1316 under construction, 827 pre-sold as at half year. Of this, when we met last time, I think we were at around 500, so about 320 units have been sold in the last 6 months. Cash collection about 1.3 billion. When we met last time was about 500 million, so about 800 billion of cash collection in the last 6 months as well. Two Rivers, 80% occupancy. Private equity, we have about 9 billion of assets. The way we've segmented our balance sheet is such that we've ring-fenced the funding for private equity separate from the funding for real estate. So PE, which is headed by Fred Muremi, who is right here, has about 8.4 billion in liquidity for deployment, and I'll be speaking a bit about it. And we completed the exit from the bottlers, 18.6 billion. This is a process we actually began 3.5 years ago, so it has taken us quite a bit of time to complete the exit. We began in August 2016 working on this exit, and we finally completed it in September 2019, and I'll be speaking more about it. And I'm also happy to see our lawyer here, Mugambi Nandi, who worked tirelessly with us on this transaction, is right there. Maybe Mugambi, you want to wave? People may have similarly large transactions and they may be looking for seeking legal services, so that's KN Associates. Fantastic, Mugambi. Then on Marketable Securities, this is a portfolio that is run by Nabo Capital. This Pius is around. Pius is right here. Pius is right here, and his colleague Suki, I think I saw around. So they run this. So because of the way market conditions are, there's been a shift from focusing on capital gains to recurrent income. So the portfolio has largely shifted to fixed income so that they can generate recurrent income. On development, I think the major impact that I'll speak about is that because of the IFRS 9 provision, and I'll defer to Sam Kariuki to talk more about IFRS 9. I remember I always tell this story when I was interviewed. The last interview I attended was in 2001 when I was joining Centum. And the then CEO asked me what are my weaknesses. And I said I'm very weak in deferred tax. So I think I'm also weak in IFRS 9. So Sam will speak more about IFRS 9 provisions. We've impaired our investment in Amu Power. We last made a deployment in Amu Power in 2015. This was in the form of a debt, and the commitment was a lot higher than what we deployed, but the deployments were based on milestones, and therefore when we hit the last milestone that they hit was way back in 2015. There's been significant delay in the progression of that project, and therefore from a prudence perspective we've made a decision to impair the entire asset, because the bulk of it was sitting in our books as a debt. We still hold a 51% equity stake in the company, but it's carried in our books at a nominal price of about $510. We believe there's a fair chance that this project will progress and will make a recovery. If that does happen, and when it happens, then there'll be a write back into the books at that particular point in time. So when you look at our balance sheet, the investment in Amu Power will not be there. From a CSR perspective, we've been focusing on a number of initiatives around scholarship, but I think the most impactful one we're currently working on is an initiative around employment. So we've been working on Ajiri centers and also creating about 10 of them across the counties. And so far we have about 5,000 people who have successfully got employment through this particular program. There was an Employer of the Year Awards, and I'm pleased to say Centum was in the top 10 actually in top 10 in all the 7 categories, and we're number 1 in a number of categories. So this sort of gives you a balanced scorecard of how the organization is doing. From a 6-month period perspective, growth in consolidated profit after tax went up 6.79 billion. Some will unpack the numbers later. I've explained the realization. Operating profit was up 49%. We had the one-off impairment of 2.28 billion. Shareholder funds at 50 billion, down 4%. That's largely because of the impairment. Decrease in long-term debt because of we repaid the dollar-denominated facilities that were sitting on the Centum balance sheet, and so there's been a decline in the debt. I'll move on to the portfolio review. NAV per share now stands at 75 shillings, and it's broken down. Real estate is about 40 shillings, private equity 30 shillings, marketable securities 4 shillings, and development is about 3 shillings. So that's the breakup of the NAV per share. Now on to address the issue of the share price. So currently, as at September, the share price was at 1 shillings and 45 cents. The cash we have, net of the bond that we've not paid, on a per share basis about 4 shillings and 80 cents, so call it 5 shillings. So the balance of the portfolio, the current market value is 26 shillings. Of that, the private equity portfolio, excluding cash, is 13 shillings. So the market is valuing the rest of the portfolio, the real estate and the development, at 12 shillings. The NAV per share on that segment of the portfolio is 43 shillings. So the market is valuing this at around 30 cents to the shilling. That is the real estate portfolio and the development portfolio, and within that development portfolio we've written down AMU to 0. So we still believe that the price is very conservative relative to the underlying value of the portfolio, of the assets that are made up in the portfolio. And I think you've seen it in the exits we've made in the past, where the bulk of the exits have been at valuations that are significantly higher than carrying value. It's also a belief that a lot of these assets are carried at fairly conservative prices relative to the realizable value. So we'll continue to work to see what we can do to unlock the value gap that exists. Again, just to speak about the valuation numbers in real estate, if you look at Vipingo, we hold 100%, about 10,000 acres. There's also developments going on there. The average carrying value per acre is about 1.5 million. The last transaction price was 10 million. I think we've done, and Ken is one who takes care of that project. Ken is right there at the back. So anything you see on Vipingo is working on it, and I think we've had transactions of between 10 and 15 million. Palmarina, we have, again, we hold 100%. It has no debt, same as Vipingo. It has no third party, we've no third party debt on that asset as well. And the last transaction price is at a higher price and carrying value. Two Rivers, we own 58% of Two Rivers. Within TRDL, you have the land that we are selling, and you have the mall. And the last transaction price was 432 million per acre. So let me speak a bit about real estate. Real estate, we had, it's a 4-pronged strategy. One is to work on infill projects within our own developments. The other one is to work on land sales so that we can monetize the land bank that we have. We have a very sizable land bank of developed land now with master planning and with the infrastructure. The third one is to rent out the properties we have, that we already have in the portfolio. This is largely the mall. We are not pursuing a rental approach going forward. So even in Vipingo, where we have a shopping center, we've sold that site to a third party developer, and they're putting up the shopping center. So for us, we're looking at real estate projects with a shorter cash cycle, where we can develop and sell, and in fact sell before we develop. So rather than develop and then wait to sell. Then the fourth pillar, which we've been working on, is third-party projects, where, because we are market-driven in our development approach, We are working with third-party landowners where we can then come and identify first locations where there's demand, and then partner with the landowners to do new developments. And I think in this second half, we may launch at least the first project under this particular scheme. And there are a number that are in the pipeline, and I think you may have seen recently we also had a signing with CPF. I think that was led by John, and that was this was a lab fund for a project in Nakuru. So we are working on a number of similar projects, really going where the market is, and then not tying up significant capital and land, but us focusing first on doing the design, selling, and then only coming in when we've market validated. Our typical rule of thumb is that we will not go to site if we've not sold at least 30% of any development. Will not break ground. And this has worked well because there are a number of projects which we've not progressed with because of market validation challenges, because the biggest risk you face in development is market risk, where you develop and there's limited uptake. The second challenge you face is development risk, just the challenges that come with the development. I think the second one we've been able to deal with them just from the experience we've had. The first one, I think that's why you can see we're at 62%, and that is all these projects have begun within the last 12 months. So that shows you where we are. So as I explained before, this is a breakdown of where we are. You can see Palmarina. So far we've sold units worth 2.1 billion. So it's 65% sold. So of everything that we're developing there, 65% of the units are sold. In Two Rivers, we've sold units worth 2.2 billion. So it's 32%. And those two are now under development. And actually about 100 units have been sold in the last 6 months. And Vipingo, we have sold 98% of everything being developed is sold. So virtually everything there under construction has been sold, and that's 1.67 billion from value of sales, cumulatively 6 billion, and we've received as of the time of doing this report was 22%, and that's largely because these are milestone payments and these projects are young. We've just begun the process. So as we progress, we continue to collect more milestone payments. We've also got into partnerships with a number of lenders who are offering our buyers credit at very competitive prices. I think we have one lender who is offering at 11% to our buyers. So this is the progress of the projects. From a land sale, which is the second pillar, so far we've closed sales of about 440 million shillings. But the pipeline is what is interesting. We have about 13 billion shillings of pipeline. When we met last, it was about 2 billion. Land sales take a bit longer to close, just because of the process. But you can see how the pipeline is looking in Vipingo, in Palmarina, and also in Two Rivers, about a pipeline of 8.8 billion. I'll show you later where we are on. The only project with the debt is Two Rivers, which is about 9 billion. But we have a pipeline of about a similar number. So even if half of this closes, the bulk of this pipeline will go towards, these sales will go towards retiring the debt at Two Rivers, because that was the development strategy of Two Rivers, was to develop the infrastructure and then sell the development rights at that particular site. So this is very much in keeping with our process. The reason also this takes a bit of time is because we are not selling to speculators. So the developers also need to develop their drawings, do their business cases. We then go through an internal approval process before we can conclude. But we are fairly confident we should be able to close on some of this in the second half of this year. Two Rivers, which is the anchor development within Two Rivers development, is now 80% let. 149 of 186 units are leased. The office tower where we are is 45% let. So this continues to be work in progress. Third-party projects, as I mentioned, we continue to make progress on those, and I think there are some that are fairly mature and they have also done well from a market validation perspective. So watch this space; you'll see them in the market shortly. I think a number of you have asked us about not just debt at holdco level, but also debt at underlying company level, and so we thought we'd share with you what the status is. As you can see there, Two Rivers Development, we own 58% because we raised equity. That's the only company, that's the only real estate company that has any third-party debt. And of that 9.2 billion, the portion that we have is with recourse to Centum is 4.2 billion. The rest is without recourse to Centum. And the mode of repayment is through the monetization of the land bank that we have there. Vipingo, Palmarina, Uhuru Heights, Rasimu, they are all equity funded, both the land and also the projects that have been done to date. We sum as a number of term sheets and is engaging with a number of lenders, so they have capacity to take on debt on their own standing without a recourse to Centum. So he's working on that as part of his development. So it's a fairly strong balance sheet, about 54 billion of assets, and really only one holdco as debt. And this debt was largely used to fund the infrastructure that you see in Two Rivers. Now moving on to private equity, which is the business that is run by, and I'd also like to thank Sam, because Sam has been double hatting as a CFO. He's been assisted by Lamek, who is right there, but he also took leadership of the real estate business. He had a lot of ideas when he was a CFO on what we could do better in real estate, and I'm glad that one of our beliefs is escalate the solution, not the problem. So he said, okay, be the solution you want to be, and you've seen how he's delivering the numbers. I'm pleased to say he's ahead of target on a lot of his numbers, and so is his team. So I'd like to thank the entire real estate team for your wonderful performance, even in the context of the environment that we are in. PE is run by Fred. So far, Fred and his team have a gross IRR of 26%. IRR, they have achieved 2.4 times of multiple, and I think the major achievement here, we closed the exit of Almasi, and that was really driven by Fred and Wambua, who is here. Where's Wambua? Yeah, Wambua is right there. Wambua has been the CFO of Almasi since 2015, but Wambua is very much a member of the Centum team. He was our director of operations at Centum, and around 2014-2015, Almasi was not doing well, so we seconded Wambua to go and be the CFO and deliver the business case and deliver the exit, and then come back. So he's achieved his mission there. So he's coming back. He's actually coming back to the team. He's just finalizing that particular transaction. I think the reason I just wanted to give you these case studies for you to for investors to get a sense of our investment philosophy, because many of you have asked me, why did you exit? What is the thinking around that? These were small assets we had. These were small bottling companies, three of them, Almasi originally. And we had 24% in Kisii, 48% in Rift Valley, 45% in Mount Kenya. We then drove the process of merger. This process began way back in 2005. We completed it in 2012, just convincing the parties, but it moved in earnest in 2012. We merged the three. We ended up with a combined stake of 27%. So part of the challenge of Almasi is that it had no owner, it had no anchor shareholder. So governance was a big challenge, and the people really who were making money in Almasi were the suppliers. So we then began the process of accumulating additional shares, because there were a number of shareholders within Almasi who were not persuaded the merger was going to work. So at the time, we gave the shareholders three options. One, you could stay where you are. Two, you could consolidate into the holdco called Almasi. Three, you could sell to Centum. And so a number of them opted to sell, so that increased our shareholding from 27 to 42%. We still did not have control, so we began picking up shares progressively, and it was not until 2016 that we got 52%. In the interim, we had a value creation plan, and really it was hinged around efficiency improvements. At that time, the EBITDA margin of Almasi was only 10%. So we saw opportunity through merger and through improvement of the leadership and the governance to significantly enhance EBITDA and position it, because we knew the long-term objective was to consolidate the entire country and present a better company that could then be part of a larger consolidation play, which is why this conversation began way back in 2016. So we moved the EBITDA margin to around 20, at its peak it was around 25%. And because we want to achieve a 30% IRR, you will not achieve a 30% internal rate of return if you're relying on market growth. You have to rely on things that are in your circle of influence, where you can drive margin up, and once you got there, you are then at market growth, and that sort of is at 5%. So you're not, so it's return dilutive. And so it was time for us to exit, for this to move on to a different owner. And I think it's instructive that now, of the bottlers that are in the country, there's only one bottler that is still independently owned, and that is Coastal Bottlers. All the others, the owners have left. So the future of this business is as one larger business, where you then have better efficiencies from an OPEX perspective and also from a capital investment perspective, because the challenge with it is that you can make a lot of money, but when you are 3 separate companies, we're then making 3 separate investment in lines and the rest. So it's very inefficient, because what counts for the investor is, at the end of the day, the free cash flow that you're getting. So if you make the money, then the free cash flow goes into capex, then it's not efficient. So as you can see, this slide is a useful one because you can see the drivers of value. So we began at a value of 1.4 billion. That was in 2012. We then have invested cumulatively an additional 1.8 billion in acquiring additional shares. So that is total investment of 3.2 billion. Debt has not had a huge impact. In fact, by the time we left, we don't rely too much on debt in our portfolio company. So actually it was unleveraged. The cash exceeded the debt. Revenue growth also didn't play a huge impact. In fact, the compound annual growth rate in volume was only 5%. So revenues accounted for 1.2 billion of the increase in value. The major value uplift came from earnings growth arising out of margin expansion. So this was the efficiencies. This created 3.2 billion. When you have better efficiencies, you have a better return on invested capital. When you have a better return on invested capital, you have a better multiple. So we moved the exit multiple from the entry multiple of 5x to 10.5 times EBITDA, and that contributed another 3.2 billion. Because the buyer was interested in acquiring this asset, we then bundled our minority stake in Nairobi Bottlers, which was 27%, which we could not otherwise have sold, and achieved the same exit multiple of 10.5 times. So we managed to get the same multiple in order for the buyer to get this asset with a control premium. The second question people have asked me is the role of dividends. If you look at from 2012 to 2019, which is 7 years, we only earned 860 million in dividends from this investment. So the bulk of the return is not in dividends, it's in capital growth. And that's really how we look at our private equity portfolio. If you want cash return, you go to fixed income. If you are in equities, it's not about a dividend play, it's about whether I can get the capital growth, because businesses that are growing also tend to be cash hungry. So they have a huge retention policy as they continue to reinvest in their businesses. So this gives you a sense of our strategy, and therefore even if we had stayed much longer in that business, there would have been no significant movement in that valuation. If anything, there was a risk it could go down because of also what's happening in the industry with EGMS, and also with a higher fixed cost base. You're very sensitive to revenues. If revenues drop 5%, it has a disproportionate impact on EBITDA. Now, if your valuation is at 10.5 times EBITDA, it means for every 1 shilling movement down in EBITDA, you have a 10 shilling impact on value, because you do not have any debt. So the timing of the exit is critical. So that's really the philosophy. The two companies were making about 400 million shillings in dividends. This is how it has played out. It tends to fluctuate. We realized about 18.6. We've paid our debt, and part of the debt we took was to acquire some of the assets I showed you, especially our real estate assets and some of our other private equity assets. So we are saving about 990 million in interest. And then the investment that we've made is earning us about 907 million. So it's about 1.9 billion as compared to our 400 million earnings. So it's about a 5x from a cash earnings perspective, or increment is about 1.4 billion. So again, those who've asked what's the impact on cash, that's the impact on cash. It's actually you're going to earn more because even if you stay, you're not earning the dividend, neither you're going to get that capital growth because you don't have more levers to drive further efficiency. You cannot go beyond 25% in this business because you have pressure on selling price, and you have pressure on costs, and you've optimized the business. So there's no further room for capital growth, which is why it makes sense to exit. King Beverage is another one which we exited, and in 2014 we engaged with Carlsberg, who wanted to come into this market, but they wanted to come into this market by building a plant. And in our discussion we said, okay, that's a good idea, but let us first market validate the concept by working on a import and distribution model. So let's import the finished product, let's distribute it, let us see what the market uptake is, and if there's sufficient market uptake, we can then build the line. Because when you build this kind of line, I think you needed to do about 50 to 60,000 cases a month for the line to work, so that at least you can run a full shift 5 days a week. If you don't achieve that, the fixed cost will just destroy the business. So it was important to market validate the idea, and we agreed to do the import and distribution model. We did it for 5 years, so we were quite patient, but we just didn't get the ramp up in volumes. We introduced a number of products, just did not work. And eventually we reached an amicable agreement, because the option was then to still proceed and invest in the line or exit the business. And we opted to exit and see how much of our investment we could recover. Here we recovered 135 million shillings. We had put in 600 million shillings over the years. So it's about, we took a hit of about 400 or 500 million shillings. But I think in the context for us, it's still better than either not having done it at all, because one does not know the outcome, or having gone straight ahead and put up a line and then ended up being saddled with huge fixed cost, and then the exit becomes very difficult, because once you put up the plant, you're then so invested you can't leave. So again, for us, if it's not working, we're very dispassionate, both when we've made money and when we've not made money. So the ability to look at an investment very dispassionately and make a decision, I think, is something that's how we look at this, how we look at things. We don't get stuck with the sunk cost. So in our view, it was better to recover this and move on to other things. Sidian Bank, the CEO is here, Chege Dumbi. So I know some of you may have questions for Sidian Bank. I'd been told some people have questions on banking, so I'm only a chairman there. So I think Chege there will be able to speak more about how his bank is performing. But he joined the bank in 2017. To his credit, we were making a loss of 122 million. The following year, he made a loss of 395 million. This year to date, he's made a profit of 67 million. We've moved the business from relying heavily on net interest income. We are making more money now on unfunded income than net interest income. He's grown liquidity strongly, so well positioned to lend more, and recently signed an agreement with IFU and with FMO. So I think this bank is on the right trajectory. Again, for some of you have asked us, what are you doing in Sidian Bank? We don't operate in the realm of perfect companies. We operate where you can move from good to great, where you can close that delta. That's where the value is created. If the business is already optimized, there's very little by way of new value that you can create. And we believe that this particular entity has significant potential for value optimization. It's still operating way below its potential. And so in closing that gap, we see a value uplift. I was just giving the example of Almasi. By the time Wambua was going into the business, the shareholders who did not participate in the merger were saying, actually, you see, we told you, we are better off not having participated. So the point is that it's not always a straight line. You'll run into challenges, which is what you can see, which is what you'll see. I'll show you the slide when you see what happened, is that sometimes things happen and then you have to go and fix them. But I think we're on the right trajectory with the bank. Longon Publishers, which is run by Maxwell Ohome, and they have the AGM later today, which Sam will be attending, and Fred. Again, you can see where the business has come from. In 2014, 105 million EBIT. We are now at 357 million. So just focusing on growing underlying value. This business was highly reliant on government business. That has come down to about 40%, from almost 99% was reliant on government textbook publishing, and then also significant diversification out of Kenya. So it's still a growth area. Some of you have asked me what's the debt in Longhorn. The debt to EBIT ratio in Longhorn is 1.9 times. So it's fairly conservative. And this debt is largely working capital. So it's financing debtors, because some of these take time to pay, and stock, because you have to buy the books. This slide shows you the track record. It will be available on the website. You can take some time and look at it. But I think the point to see is that the 26% IRR is not concentrated in one or two assets, but it's really spread out across almost all the assets, including some of the ones that we bought recently and exited. Those are the ones in yellow there. You can see assets like Abbasid, Longhorn, Gen Africa, Platcorp are fairly recent acquisitions. We're also able to exit. And then some of you have asked me about the exit period. You know, the exit period is determined by how much time you take to unlock the uplift. If you take a shorter time, then if you stay any longer, then it's return dilutive. Because then that period that you're staying, you're not getting any uplift because you sort of optimized the asset. So once your mission is done, then it's time for you to leave. And we've not struggled with exits, largely because from day one, you know you're going to exit this business. And we are not shy about speaking about it. In fact, I was talking to Chege, I think yesterday, and I was telling him, you know, in 3-4 years when we're exiting, these are the things we need to show the buyer. So you have to work backwards from there, knowing that you're preparing every company for an exit and you're looking to make a 30% IRR. So you know, you make the companies a lot stronger, and they go on to do very well, sometimes in different hands. But the idea is to do what you can, the best you can do in the period that they're in our hands, to make them far better businesses than we found them. And we are proud of what we did with a lot of these entities. So we are now setting up so Fred has a bit of firepower. He's sitting on about 8 billion shillings to invest. But we have far more investment opportunities than we have capital for. And what we want to do, lessons from the last time, because we want to keep the Centum balance sheet debt-free, we don't want to leverage it. If you remember when we began this journey in 2009, when I took over as CEO of this company, I found exactly 10 million shillings of cash and an overdraft of 180 million. So we grew through borrowing, paying. But we've reached a point where now we don't need to do that. So we want to keep the Centum balance sheet largely debt-free. We want him to deploy what he has. But because he has more opportunities than the capital, he's then looking to bring on board other investors that they can co-invest with, and then have a dedicated fund that can then have at least 10 years to maximize value and carry on with the same strategy. Really, a business that has some form of market leadership in a particular market segment with a competitive advantage, and where you can get a significant stake. The importance of the stake is that it gives you two things. It gives you the ability to implement your value creation strategy. It makes it much easier for you to make decisions. Wambua will tell you we made very important decisions in our monthly business review meeting, because all these companies where we have that are our subsidiaries, we meet once a month. And so you're making quick decisions with the owner very quickly. And then it gives you the second thing, the ability to get a fully priced exit, because when you're selling largely to a strategic and they want to buy control. So if you don't have those, then it doesn't make sense. Now, it then needs to have something that makes it not optimal. And a lot of what we are seeing is companies that have the wrong capital structure, where they have borrowed and put money in fixed assets, and so they are short of working capital, and therefore they need to restructure and bring on board equity. And a lot of our players in this market, they are shy of being controlling shareholders. They are looking to be minority shareholders. For us, we want to be the controlling shareholder, largely because our other competitive advantage is governance. The reason we've been able to exit all these companies, that we're able to pass the due diligence of very sophisticated investors. So if I take an example of the last exit, the due diligence process lasted a year, and there are no new findings. So if you don't deal with the governance issues up front and the risk issues up front, you will not be able to get an exit, no matter how good that asset is. And so unless your counterparty has a better governance structures than you, then it's better that we be the one in control. But sometimes we have counterparties who are just as good or even better, and we've backed them, and we've, like Platcorp, for example, we're the largest shareholder, but we worked very closely with the management shareholder. So we are seeing quite a bit of opportunities. So this team is quite busy, and that's why they're raising a fund too, just to carry on with that strategy. But they don't have to wait for the fund to close for them to start deploying. So that's the fortunate position that they are in. So when we started working on our strategy, because we started on this process 24 months ago, we looked at the economic conditions, and the idea is that you have to be able to succeed regardless of what the economic conditions are. And we thought that in the current environment, you're getting into a buyer's market, so it makes sense to have cash rather than have assets. And it makes sense to have low leverage, because then it gives you ability to be able to borrow more, because the debt capacity still remains. Development, Akira Giodamo, the CFO, is here. His name is Anthony Kahindi, is right there. So if anyone has a question on Akira, they can Anthony will respond. I think here the significant thing that has happened, we have everything. We have the power purchase agreement, the letter of support, we have the land. We've just completed an exploration survey. We did a fresh one with a new partner. And we are now discussing possible investment by that partner and also how we're going to go into the drilling phase. But the results have been very, very encouraging, at least for the first phase, which is 70 megawatts. Amu Power, we also have had everything. We had been issued with an EIA license. As some of you are aware, in June, this was revoked by the National Environmental Tribunal. Amu Power has appealed this decision, so they're in the High Court. We don't know when this matter will be resolved, and without this license, you cannot progress to financial close. And so, our view is that it's best then to make a full provision on the debt that we had provided the company, the shareholder loan that we had provided the company. We are not accrued for any interest, and then follow up the matter, support the company, and see to what extent we can either carry on as is or reconfigure the project, because the country still needs additional power. If you look at this power that will fall off, particularly the thermos, they're falling off, and the only new power that is coming on stream in significance is geothermal power. So, and this was in the least cost power plan. So there's options that we are currently exploring. ACE, this is the school we set up. ACE is actually a company that has schools across Africa, so currently working on Egypt, but the first school we did was in Kenya. We have a number of other partners. It was a development play, so we did not want to commit too much capital to it because it will take time to start generating a dividend. But we encouraged. We opened in 2017, 54 students. We are now at 156, and the numbers are ramping up. Greenblade is an agricultural venture. Again, it's part of the development portfolio. It's not too big, but it's also growing well. I don't know if there's anyone from Greenblade. Marketable Securities, again, as I mentioned, the focus now is capital preservation and cash return. So they are working on a Pan-African fixed income portfolio, and they're also managing some of Fred's money as he looks for the opportunities. CSR engagement had shared. So I want to invite Sam to take you through the ins and outs of the financial performance of the business. Thank you very much, ladies and gentlemen.
Thank you, James. Warm good morning, everyone. So I'll go straight to the numbers. So James has largely covered what were the key performance drivers, and we summarize those in 2 bullet points there. One is the investment income, 12.4 billion investment income recorded. It's about 2x what we reported last year. Of this 12 billion, the larger component is the realized gains from the recent transaction that James spoke to on the sale of Almasi and the Nairobi Bottlers. At consolidation level, it's simply the sales proceeds of 19 billion, less the taxes, and then less the cost and the goodwill that was sitting on the consolidated accounts. I will speak more when I get to the company on what IFRS 9 has meant to how we'll be recording these gains looking forward. James also spoke to the AMU provision, the debt instrument provision, and probably I could spend a minute there talking about this. Under IFRS, because it's a debt instrument, you would at any point consider the time to when this cash can come and then discount that at a particular interest rate. That's a requirement of IFRS. And therefore, this is then a timing consideration of when would we anticipate the resolution of all matters, getting to financial close, and being able to recover this amount. And therefore, after you do the IFRS mechanics, the amount is not far from a nil carrying value, and therefore we've done a full provision. There is a difference between fully providing and writing off, and the point I want to make there, the amount is not written off. It's a provision, a separate provision recorded. So the carrying value in our book is nil, but the contractual liability remains outstanding to Centum. With that said then, that is our consolidated income statement, ladies and gentlemen. We have always segregated this between what we'd call trading companies. Primarily, these were the beverages. We have consolidated the beverage companies up to September because the transaction happened in September. Effective 30th September, then we have deconsolidated the beverage businesses. So that is reflected in half year. As you go now to the full year, obviously so for this full year, FY20, that line will remain. Moving forward the next financial year, the line of sales of beverages will drop from our consolidated income statement. However, while you see a profitability there of 254 million, the question is what replaces that? As James mentioned, a significant portion of those proceeds have gone to a marketable securities fund, generating up to about 1 billion Kenya shillings. So while that trading profitability drops, do you expect then the investment income to go up by at least 1 billion? So net on net, actually from the transaction perspective and impact on the consolidated income statement, it will be a 700 million increase on consolidated profit looking forward. The other impact from that transaction is on the finance cost, as you can see from the finance cost of 2 billion. From the repayment of all the term loans, the USD denominated term loans and the revolving credit facilities that we had locally, there will be a saving of about a B in finance costs. So if you look at the overall impact of that transaction on this consolidated statement, projecting forward, is a 1.9 billion positive variance. So that is on the sales, the trading business. So that will remain looking forward, largely the agricultural business and the Longhorn publishers. The next section of the income statement is on financial services. The largest asset there is the bank, Sidian Bank. We also consolidate NABO as an asset manager. We have Zohari Leasing, about a three-year business. Key performance driver there is Sidian Bank. As James mentioned, if you look at this business between 2017 and currently, 2 years ago, our loss in that business was about 400 million. It has now turned to the positive territory, recording an 84 for the 9 months, January to September, recording about 84 million Kenya shillings in profitability. There will be, if you compare these results and what they published in September, the dates are different. They report January to September. We adjust that for the April to September because our year-end period is March. What to note about the financials of Sidian? Last year and this year, the non-funded income continues to outpace net interest income. And therefore, the strategy that the bank has been reporting on focusing significantly on the non-funded income is actually paying off and has consistently paid off. If I look at period to period, that non-funded income line is up 47%. The bank has recently closed on some facilities. We just saw a recent announcement on a new 2 billion facility. There was an injection of 1.2 billion last year by IFU. We also, as Centum, recapitalized the bank by another 1.2 billion last year. So in addition to the non-funded income, the bank now has a very strong balance sheet to continually grow its assets and continually then also grow the net interest income. So from a strong balance sheet perspective, we, from now on, other than just being profitable, it's on a strong position for growth. Then the rest of the income statement is about our investment operations outside of the trading companies and the bank. That's why we talked of the realized gains. And the question then becomes what replaces that. As I mentioned, from this transaction, you'd expect our interest income looking forward to be to come there. But also on the real estate side of the business, as you pre-sell, as you collect deposits, until the point where you hand over a unit to the buyer, the deposits collected sit as a liability on our balance sheet. So as we speak, we've booked potential sales of 6 billion shillings. They would not reflect on this income statement. This is inventory, as accountant would put it. It's inventory that is work in progress. And from the next financial year, we then expect a new line of sale of residential units to start playing a significant role in this income statement. So at the moment, 1,300 under construction to be handed over to owners anywhere between March next year and December next year. And therefore, in the next financial year, you expect those sales of about 6 billion to be reflected. More than 6 billion, actually, because the 6 billion reflects 63% of the pipeline under construction at the moment. Obviously, we continue selling, and assuming we sell whatever is under construction today by the next financial year, we are talking of 10 billion plus in new sales coming into this income statement. The question there then is, after the 1,000, then what? If you recall that previous slide on real estate, the actual pipeline under development currently on our own land alone is about 3,200, of which phase 1 is about a third of that under construction. So if you go to any site, you will find we have project size, for argument's sake, in Vipingo, where Ken is leading the project, 1,200 apartments under development, of which, in his case, the first phase of 30% of that is under construction, and it's within this 1,300 that you're talking about. But he continues to sell the balance. For example, recently, he has also market validated the next phase, and we should be issuing a contract to increase that 1,300 further by another, say, 300. So we have a pipeline currently under development of 3,300, which, if you average, then you'd argue over the next 3 years, at a minimum, 1,200 will be the inventory of the stock that comes to market from just our own land. Also to note, on our own land, the sale has 2 elements. There's a sale and the profit you make on the residential unit, but also you are developing on your own land, meaning the land holding company is selling land to the residential development company, and there's an actual monetization of the land. So while as James was talking on the monetization of land, there is the monetization through development and sale of residential units, and direct sales then to other developers. So we would expect then this income statement to be reflecting sale of units and profit that we are continually making from sale of land. It is significant. If I look at Vipingo, for example, if I compare the carrying value vis-a-vis the price of land implied in the units that we are selling, say on the maisonettes, it's about 9x from a carrying value. So we expect significant gains now looking forward to come on this line of investment income. The next item there to talk about is on the impairment of assets. I've talked about that, the 2.2 billion. This is one-off, so you'd expect that line not to be repetitive looking forward. The finance costs of 2B, both for company and consolidated overall for other subsidiaries, mostly at Two Rivers. We expect at a minimum that to drop by half looking forward, having paid off the debts that we paid off. Next year then, when we redeem the bond that is maturing end of May, early June, again we'd expect at Centum level the finance cost to drop to nil. On the operating costs, if you track how we've been managing the cost between 2016 to date, significantly with the businesses becoming very operational and very efficient, overall cost at Centum level and at subsidiary levels have been coming down. All those drivers, in a nutshell, our half-year profit relative to half-year 2019 is 222% up from 2.1 billion to 6.8 billion Kenya shillings. Thank you. Thank you for that. So that's the consolidated balance sheet. Consolidated balance sheet, simply a summation of all the assets, all liabilities of companies, whether you own them 100%, whether you own them 50.1%. And that's why then you will see everything from the real estate businesses to the assets of CD and Bank, the loans and all. The only assets that are not reflected here would then be and that would have been there last year, would be the assets of Almasi. That's why you're seeing a significant drop on PPE from 11 billion to 3.8, because the deconsolidation happened effective 30th of September. The investment properties reflect the land bank significantly and the serviced land. The other element that will now start coming here significantly on that line of inventory, previously it would have been the inventory of Almasi primarily. Now the new inventory line will be the residential units we are developing. Under IFRS, you would not classify them as investment property, but residential units, rather as inventory, because it's something that you're developing with an intention to sell. So total assets at group level, 104 billion shillings, marginal increase from 101 billion shillings from last year, translating to a net asset value after deducting liabilities of 46 billion of about 57 billion. Then we come to the company itself, Centum as a standalone company, which then simply takes its share so to speak, of the respective portfolio companies. So dividend income up about 45%, the operating context notwithstanding. The realized gains is something I want to discuss a little bit, of 2.2 billion, and why is it different from the 12 billion. Previously, before IFRS 9 came into play, the gains you'd recognize when you sell an asset would be simply a comparison of your proceeds less your original cost of investment. And effectively, using accounting parlance, what you'd have done is any unrealized gains which would have gone to equity or to other comprehensive income would be recycled through the profit and loss. So if you look at historically how we have reported our realized gains, it's always been what you sell, the proceeds, less what you invested in originally. Now, IFRS 9 for Centum became effective this first financial year. It was effective 1st January 2019, so we've adopted it. And according to IFRS 9, anything you have previously recorded under other comprehensive income will go straight to equity, not through P&L. So that's a very material change for us. If I was to compare this with what it would have been before IFRS 9, that line of 2.2 billion would have been 19 billion less the original carrying cost of these assets, which was 3 billion. So the realized gain would have been 16 billion. So the term realized gain remains. So there is a realized gain of 16 billion at company level, but 3 billion or 2.2 billion is what goes straight to income statement. The other portion of 14 billion realized gains goes straight to retained earnings on equity. So that's a material change. So like for like comparison, if I compare half year 19 and half year 20, it would have been a 16 billion gain, but for the IFRS change. But I suppose that also speaks to the focus we've always had as a company. Remember, when we discuss the performance of Centum, we rarely ever focus on the profitability. We talk of the total return statement, which is what has been realized in cash, dividend, and realized gains, but also the fair value gains that will be realized upon a sale. So in a way, IFRS 9 does speak to how we have always viewed the performance of our company. On that account, therefore, the operating profit of Centum is up 49%, just about 50%, from $1 billion last half year to about 1.5 billion this half year. There is the impairment of 2.2. It's recorded both at consolidated but also at company level, where this asset was held as an investment in a joint venture. So if you less than the impact of this one of impairment, the reported performance will be a loss at the company level. To speak to this statement, given the comments I made earlier on the performance of real estate specifically, so from a private equity perspective, it will continue to be the same play, where for new investments, you have dividend income coming in. You have now interest income from the significant marketable securities we are investing. The way real estate performance would be reflected on this statement would be through dividends, because we hold the real estate business separately as a portfolio company. So any profits realized there then would be paid up as dividends to Centum, the parent company. And therefore, you'd expect that dividend income looking forward from the next financial year to have not just a private equity dividend payout, but also dividend from the real estate business. I have told James I cannot wait to pay our first dividend from real estate to him next year, and I'm comfortable that will be achieved. So that's a company balance sheet. In looking at Centum, between consolidated and company balance sheet, the company balance sheet is the most important because now this reflects our actual share and holding of the respective companies, specifically where we don't hold 100%. You would expect overall total assets to drop because of two items. By paying down debt, it means you are moving cash balance down, but also you are reducing your liabilities. So the significant movement there is a payment of 7.5B RMB debt, but also the impairment of AMU, the 2 billion provision that we have recorded against AMU. So if you look at those two, it's about 10 billion shillings, and that's why then the total assets would drop by just about that much. But on the other side, again on the total liabilities, there is a drop of that 1%, significantly from the payout of the borrowings. Of this 9.9 billion, 6 billion is the bond. 3 billion is short-term revolving credit facilities, which were paid subsequently in October. So as we speak at the moment, the balance sheet has only the bond outstanding. So shareholder funds, a drop of 2 billion, not surprising because of the impairment in the AMU investments. Leading then to an NAV per share of 75 shillings. James did speak to how that compares to the market valuation. Which brings me to the gearing and the liquidity position of the company. If you look at now the outstanding debt, it's 6B, payable in less than a year. So 1 year from now, in the next half year, September next year, we would expect no more debt at Centum level. I suppose we can look at it from two perspectives. Strictly speaking, 6 billion level of gearing compared to the 70 or so billion total assets is not significant at all from a gearing perspective. We've largely been very comfortable with the level of gearing, which you look at from the parameters of gearing versus equity. It has always been low, below 30%. But also more importantly is the cash flows you are generating from operations vis-a-vis the servicing costs. Our covenants requires to have a 1.5x debt service coverage ratio. Traditionally, we've always trended above 2 and almost 2x of that. So we've been pretty comfortable from a debt servicing perspective. The payment of this next year would mean that the total finance cost of Centum dropping from 1.6 billion to 0. So that almost automatically adds a 1.6 billion profitability to the income statement looking forward into the next financial year. From a liquidity perspective, the table to my right, what you'll see in our balance sheet is a cash balance of about 12 billion shillings. We continue to hold marketable securities portfolio of 2.8B, which serves as a treasury reserve, but also gives us some annuity income. So if I combine the cash and the marketable securities, mostly fixed income, just slightly short of 15 billion shillings. If you then deduct the short-term credit facilities, the OD and the revolving credit facilities of 3.5B, and also deduct some significant current liabilities that were paid in October. This primarily would have been the CGT, the capital gains tax payable on the transaction, and the dividends which were paid in October. If you deduct that, then the net cash or net liquidity currently being held is about 9.6 billion shillings. Meaning then that in terms of the total liquidity available to the group and primarily to the private equity business for investment is this 9.6 billion, and the 4B line, which remains a committed but undrawn facility with our partners, and I can see Anne representing Standard Bank. So the total available liquidity to us is about 13.6 billion. Largely this will go, a portion of this currently is marketable securities. Largely this will go to funding the new investments that Moremi is looking at. In terms of how we report this internally, the funding is very segregated between real estate and marketable securities. We operate, we have the discipline of operating them as separate funds. So they are really, if they say an exit on the private equity side, those are not cash flows available to fund anything on the real estate side. So we do segregate and manage the treasuries very separately. That is then the company statement of cash flows. I think significantly summarized in my previous comments on the liquidity. Not surprising, cash generated from operating activity will be 19.7 billion, largely reflecting the cash flow or the proceeds from the Almasi sale. No significant investment as of yet. About 663 is what has gone to some investments. Borrowings payment on a net basis of 7.4B, leaving us with a 12 billion cash holding as at September year end. So that, ladies and gentlemen, is the brief commentary on the financial performance at half year. I will ask James to come and conclude on the outlook for the remainder of the year and looking forward. Thank you very much.
Thank you, Sam, for that presentation. So the outlook is brief. For real estate, Sam's mandate is to start paying a dividend. Everything he has done is not yet reflected in our P&L, so we expect it's going to be reflected in the future. Private equity, which is Moremi and Wambua, they are looking at new opportunities. This is going to be largely longer term because if you're getting entry now, it's going to take time for those sort of ramp up. So that's what they're working on. Marketable securities to continue generating cash. Development, hoping to make progress with Akira this coming year, to carry on with ACE and to carry on with the projects we're doing on development. Overall, I think we're on track from a return on NAV perspective. Our target over the next 5 years is to keep it around 20%, so we're not too aggressive on that. I think the market offers interesting opportunities that we expect to exploit. So I want to take this time now to take any questions. Myself and my colleagues will take any of your questions, both the ones you'll ask here and the ones that may have come online. So does anyone have the online questions that we can take? I have seen one already when I was sitting there from Twitter. I can be answering it. Somebody has asked me about the interim dividend. And the answer to that is that we have a dividend policy. And our dividend policy provides that we'll pay the higher of previous year's dividend and 40% of recurrent cash income. And because the previous year's dividend, which is about 800 million shillings, is still higher than the 40%, we are maintaining the current, we're going to pay dividend within the dividend policy. So that's why there's no interim dividend, but we expect that this should be the normal final dividend. Yes.
Hi, James. I have a few questions.
Yes, please.
They'll apply to the different aspects. The first one is on the accounts.
Maybe you can introduce yourself so that people know who's.
My name is Kunal Bid. So the first question is on the accounts. The operating and admin expenses was 0 in 2019, but 2 billion this year. I don't know if I missed something there. Why is that?
Okay, I think.
Shall I run through all of them?
Just run through all of them and then we'll pick them.
Okay, then I want to understand how the CGT on the Almasi deal works. Is it based on your investment from the start versus your exit price?
I get you.
Now, there's this new law about the 51% ownership and the acquisition. I think a lot of the lawyers have differing opinions on it.
Yes.
And what impact is this going to have on PE investments that you're looking and your PE pipeline moving forward?
Okay.
And then finally, I think it's come up in the past, is about share buybacks and how you're dealing with that now that the CMA is given clearance for a share buyback.
Thank you, Kunal.
Thank you.
Thank you for those questions. Can we take, there was a question here.
Thank you for the briefing. Congratulations on the numbers. First question I think would go to Sam. I think we have the same weakness with James. Matters to do with IFRS 9. Kindly sort of repeat what you said on the difference between 12B in realized gains at the group level and 2B at the company level. The other one was still on the real estate bid, that you expect to realize some sales next year. So I think we are looking forward to that and a bit of dividend income. Question is, does that present an opportunity for Sidian Bank to grow its loan book? The third one is, I've seen from the company's cash flow statement a purchase of unquoted shares. If it's possible, kindly enlighten us more on which company that was. Thank you.
Okay, thank you for that. Maybe we can take another set.
Good morning. I'm Daniel Okoth from ICDC. I didn't quite get your justification for exiting Almasi. Could you kindly revisit?
Okay, thank you for that, Daniel.
Good morning. My name is Moifa with Radio Citizen and Citizen Digital. Two questions from me. One is on Amu Power. I don't know with the provisioning whether you've changed your stance on the development side. Especially, we note that you have a lot of interest in energy, but we've seen a bit of pulling off, especially in dirty fuels. If I may put it as such, we've seen AFDB and the EU also suggest a pull out. I don't know what changes on that side. My other question is on marketable securities. You say now it's more of a move towards the fixed income portfolio, meaning a lot of government securities. I don't know whether that changes your guidance, because I saw your guidance on Centum 3.0 is about keeping a marketable securities portfolio of 20 to 30%. Don't know whether that changes.
Okay, thank you. Maybe we can answer those questions to begin with. So, Sam, you'll take the one on operating and admin expenses. Just tick that. CGT on Almasi. 51% ownership. The man sitting next to you can pick that. Please don't send me a fee note. I'll take share buyback. I think there was a question on whether you'll pay dividend or whether when you complete your real estate sales, those will come through. We can pick that. There's a question of investment in unquoted in the cash flow. You can pick that. I'll pick up Okoth's question on ICDC exit. I'll also pick up the provision of AMU and marketable securities. So as you prepare your answers, let me just pick up my questions. Okoth, your question on the ICDC exit, sorry, not the ICDC exit, the Almasi exit. It's informed by what took us there in the first place. What took us there in the first place, and the reason we drove the consolidation, is because we saw opportunities to optimize the business and grow the major driver of value, which is EBITDA, earnings before interest, tax, depreciation, and amortization. When we got into this business, the EBITDA margin of Almasi was 10%. The EBITDA margin of Nairobi Bottlers, which is the same business, was about 20%. So for the same level of sales, for every 100 shillings in sales in Almasi, when we combined, we were only making 10 shillings. In Nairobi Bottlers, we were making 20 shillings. The reason that was the case was largely because of governance issues and leadership issues, and also underinvestment in the business. But that opportunity is not an infinite opportunity, because then you'll close it. And that's what we've been working on from 2012 to actually around 2017, when we took EBITDA margin to around 25%. Once you get there, then what you're now relying on is market growth, because there's no further opportunity to create value from efficiencies. You're now relying on market growth. If you look at this chart, it has disaggregated the sources of value. If you look at the revenue growth component, which is the first one there, it only contributed 1.2 billion shillings on the value uplift. So if you're relying purely on the market to grow your volume, and you're not an active investor actively trying to extract efficiencies, you're not going to get a double-digit internal rate of return. You're going to get a single-digit internal rate of return. Now, once you finish, which is why we completed this process, I think by 2017 we were already at 25%. That's why we began the exit discussions then, because there was no further room for value creation beyond relying on the economy growing and consumer purchasing power increasing. That's why we began that process. And you need to think upfront who is going to buy your assets. So a lot of these assets, when we come in, you have to think, what is your exit strategy? Who would have an interest in this asset, and for what reason? That's why there was an interest, and that's why we began this conversation way back in 2017. That's a justification. We went there to create value. We also went there to be able to get an opportunity to also exit our other minority stake. It's very difficult to sell minority stakes, largely because the majority owner has no reason to buy your minority stake. They're already in control of the business. Everything they can do, they're able to do. But when you bundle it, you have now something of value, and you can bundle another asset that you'd otherwise have had difficulties exiting, because the dividend yield of this asset is about 2%. So you're making a 2.4% dividend yield in an environment where on fixed income you're on 14%. So you have a negative spread of 10% with limited opportunity to create additional value on this other side from a capital gain perspective. That's why it makes sense for us to exit. Why it makes sense for the buyer to buy is because they own the rest of the plant. So when they consolidate, they'll have a further round of efficiency improvements. That's one. Number two, they have excess capacity in certain categories, which is not fully optimized because you're only selling within a limited territory. So when you combine now, you have opportunity to get a better return on capital on the capex that you have put in. So that's the justification, and the reason I've taken time is that it informs the investment strategy. So unless Fred can demonstrate in a company that he can get his 30% IRR without relying on economic growth, because that growth will not deliver much from a return perspective, then it doesn't make sense for us to come in. And that's why he has to have control. Because if you don't have control, you're relying on another person. Now, if the person you're buying from was not able to achieve it when they were in control of the business, how will they be able to achieve it now that they carry on? So you have to see what is going to be different in the business. So that's the reason why, and that informs our investment strategy. I hope I've answered. Daniel, I hope I've been clear with that question. On the question of the provision of AMU, the provision is driven by IFRS. It is not driven by the merits or demerits of the company. So IFRS does not take into account our views on the prospects of the business. And I think, Michael, you can correct me. It's strictly application of IFRS. So the IFRS has not provision, does not in any way alter the prospects of the company. We remain investors in that company, and as responsible investors, we'll try to do our best to pursue a return on our investment. But accounting is different from our pursuing of our return on investment, so we have to do the right thing. There was recently a news article about EIB having withdrawn funding. The reality is that EIB are not given us funding. EIB are not given funding to Akira. EIB had listed Akira on its website as one of the projects it was considering funding. But because there's been a delay, they then dropped Akira from the website. So that's what happened. There was also news that AFDB is not going to fund AMU. AFDB was not a funder of AMU. AMU's financial close was from the Chinese banks. AFDB was supporting the government of Kenya in the provision of the partial risk guarantee, which is one of the obligations of government and our government of Kenya letter of support. So I think there was a misclarification, but the challenge, even when you clarify, sometimes it's on page 22 at one corner, so you will not be able to see it. So I wanted to take this opportunity to give that clarification. So we are carrying on. You know, these are long lead projects. If you look at how long it took to deliver Lake Turkana wind project, it took a long time. So you have the ups and downs that are normal with these projects, but we'll carry on with what we are doing. Now, marketable securities. Within the marketable securities universe, you have listed equities and your fixed income securities. So what the team does is that, depending on the market conditions, they will change the weighting between either listed securities or marketable securities. Again, when we speak of fixed income securities, don't restrict your thinking to just Kenyan securities. So Pius invests on fixed income securities across the continent, not just government of Kenya securities. His mandate is to make money, regardless of economic conditions. So I always share with my team a story of two people who met an investor briefing such as this. And one person says, I hear there's going to be a recession. And the other one says, I've chosen not to participate. So I always tell them, we've chosen not to participate. You need to make money regardless of, and achieve your objectives regardless of economic conditions. So typically we don't have a slide on economic conditions. That's why it's not here. Because you're meant to make your return regardless of economic. That's why we did not spend 3-4 minutes telling you about economic conditions. So I think now we can move on to Sam. Maybe you can. Who has the microphone?
Thank you for the good questions. The question on operating expenses, so there are two lines on the income statement. There is OPEX, dropping from 684 to about 550. So that is fine. The one you're referring to is the impairment provision on AMU, shown separately as an expense. Then it would have a nil. Okay, maybe you're looking at different things.
No, I think what is confusing him.
So if you look at this slide that is there, impairment of assets 2.2b. Yeah. So that's a one-off item. The next question was on the recycling. So let me put it in very simple terms. Previously, actually before 2007, there was nothing called other comprehensive income. It was simply an income statement, and any revaluation gains, whether on land or in this case, for our case, equity investment, they would go straight to equity. You would then only take them to the income statement after you realize the sale, but you'd compute your gain as the proceeds less your original cost. And therefore, because you have now realized it, those reserves which you have accumulated in equity would then go to the income statement so that they can go to retained earnings, not straight from a reserve to retained earnings. And then sometime in 07, then IFRSs were changed, and we started showing what is called total comprehensive income, which is profitability, as it was reported previously, plus all these other gains, which were then called other comprehensive income. But still, the practice of computing gains as proceeds less cost continued. So anytime there was a realization, what has been accumulated as fair value gain would move from this line called other comprehensive income to realized gains. And that's how our profitability has been reported previously. Now, IFRS 9, one of the major changes, most people know IFRS 9 for changing the way provisions are computed, but one of the other major changes specifically affecting us is how you classify financial instruments. Previously, there were 4 different types of financial instruments, available for sale, held to maturity, fair value through P&L. All that has gone. And now you have just 2 general classification. It's fair value either through P&L, straight to P&L, or fair value through other comprehensive income. Because we chose the other comprehensive income route, it means any cumulative gains we record going to other comprehensive income, once you realize it, it will never go back to profit. Yes, but it's realized and it goes straight to retained earnings. I hope now that is okay. In the simplest way I could put it. On AMU, the clarification I made is very important to state and restate it. The asset has not been written off. The asset remains. The contractual liability remains outstanding. A provision in IFRS simply says, I have 2, we'll get it for argument's sake in 10 years, discount that using a present value interest rate of X. What's the value? That's really an accounting. And you don't record it against the asset, you record a separate line called impairment provision so that the combined carrying value is nil. But the project continues, the asset remains outstanding in our books, but shown at nil carrying value. That's an important clarification. Then the investments that you have seen, a small investment. Remember, we continue with our Akira project, so a portion of the investment has gone there and a portion to the school.
Okay, then Mugambi, you can give some legal advice to Kunal on the issue of the law. Are you finished?
Yes, I'm finished.
Okay. Kunal wanted some advice. I think as you do that on CGT, which you're meant to answer, it is based on the original cost minus the selling price.
Minus the selling price, yes. 5% of that.
5%. So we paid about 880 million. 880 million, yeah.
I think Kunal is asking about the recent amendment to the Companies Act, which allows a shareholder who has 51% shareholding in the company to squeeze out the minority shareholders. And it hasn't quite been used. I think the PS Transport, Esther Koimet, indicated that KQ might use that. They might be the first company to use it. But there isn't consensus amongst lawyers on exactly what process that is going to be followed. Because there's one school of thought that says you make an offer to the minority shareholders. If you receive 50% from those minorities, then you can buy out forcefully the remaining, the 50. So you have 51, so there's 49. You make an offer to the 49. If you receive 50% of the 49, then you can buy out everybody else. Previously, you needed to have received up to 90% in order to squeeze out. I think that's a question that was being asked, and as I'm saying, it's not quite clear how it's going to play out. There's also the question of whether it's going to apply to private, that is non-listed companies. My own view is that it's not going to apply to private equity, that companies which are not listed, because the process of making an offer to take over is in the Capital Markets Act. And the Companies Act, even though it applies to all companies, private and public, specifically states that the process of takeover, is governed by the provisions of the Companies Act, of the Capital Markets Act. Therefore, I have my doubts as to whether the provisions in the Capital Markets Act and the regulations governing takeover would apply in a private equity setup. Thank you.
Thank you very much. So Mugambi is smart enough to say just enough so that you still follow up with him. Maybe then you'll get, but not too much. So I think we've addressed this round of questions. We can take another round of questions. So
Giorgio Bulutza from Reuters. Just seeking clarity, the accounts you published in the newspapers, the PBT for the group for HY19 had 2.55, and it was seeing on the slide it has 2.39. What's the difference with that? And also, just to get clarity, confirm whether or not it's the case that for the coming year, it looks like real estate is what is going to be driving the company's performance. Thanks.
thank you. So there are two questions. I think one is a clarification question, which I'll let you answer. The second question was what will drive the performance. So Bulutz, I think several things will drive performance. If you compare this year's performance and what we expect this coming year, I expect to see higher investment income because we have higher cash now that has been deployed in fixed income securities, which was not there previously. So previously we were probably earning 400 million shillings in dividends. That will be replaced by a higher investment income, as I've explained, about 1 billion shillings. The second driver is going to be a reduction in finance costs. In the past, we've had about 1.8 billion shillings in finance costs, which will not be in the P&L going forward. The third thing, as you've correctly pointed out, we expect to see real estate making a contribution. In the past, it has not made a significant contribution, especially the sales that it's doing, and so far we've not booked any sales. Private equity, I think that will, besides the current assets that we have, the new assets will come in on board sort of progressively over time. So we'll not see a major contribution from that in the short run. And we want to see what's going to happen with the development assets. That's the other thing we are working on. I hope I've answered that question. I think there's a clarification question regarding what has been in the papers and what is in the slide. I don't know whether you're able to do that or you want to do that offline. Maybe you can check. Maybe they need to compare and we'll engage after the briefing. They need to see what's in the papers vis-a-vis what is in the presentation. Any other question?
My name is Maggie Njuguna from Capital FM. So in the half year 2019-2020, you've said the disposal of Almasia and Nairobi Bottlers contributed to the 6.8 billion after-tax profit. So I wanted to know, in the second half, do you probably expect to dispose some of your other assets to probably drive profitability in the second half? I didn't quite get that.
So Maggie, thank you for that. No, we are not looking at major disposals going forward. We are looking to working with what we have, as I've explained, what the drivers of earnings will be. And really our focus is on that return on net asset value per share. So I don't expect you'll see any major disposals in the second half beyond what they do routinely in terms of sale of bulk land and sale of assets. I think I also put up on the slide the bulk land pipeline. It's about 13 billion. So you may expect some of that to close, and if it does close, then it will play a driver, it will play a role in the earnings in the second half and even in subsequent years. Any other questions? So we'll be available to take more questions, and so are my colleagues. They're available to take more questions. I think some will look at that and provide it's the same thing? Oh, thank you for reminding me. Have you checked the earnings? It's the same. No, the bottom line, 2 point something. Okay, so why don't you engage with Obulusa just now and check whether there's a discrepancy. I think on the share buyback, the guidance we got from CMA is that individual companies can give their own proposals, and then CMA will take that into consideration. It's something that we are open to, but we need to build up our cash flow so that you then do it when you have surplus cash from a buyback perspective. Our free float is quite small, so our own sense is that if we did a buyback of some of that free float, it may have a material impact, positive impact on the share price. So it's something that we'll be actively looking at. That's the answer on the share buyback. I think we've answered all the questions, so I want to thank each and everybody for your participation. Those who've participated online, thanks a lot. Those who are here, we really appreciate your participation. Thanks a lot for your questions. Thanks a lot for my colleagues and partners who are here for all your support. This would not have been possible if it's not a team effort, if it was not for the collective team effort of everybody. And we look forward to continuing to deliver to promise and to continue to deliver as per the strategy that we have set out. We are available to address any further questions that you may have, and please feel free to post them. Thank you very much. There's still breakfast available, and we look forward to interact with you. Asanteni sana. Thank you very much.